some type of financial information. Accountants accumulate all of the data from the different accounts and place this data in financial statements so inquiring minds can analyze the financial condition of the business.
I want to know.
Good financial statements are absolutely essential to companies because they can help to evaluate the health of a business.
The most important financial statements are the income statement, the statement of changes in owner's equity, the balance sheet, and the statement of cash flows.
We will concentrate on these three financial statements: the income statement, changes in owner's equity, and the balance sheet.
The income statement looks at the profitability of the business for a specific period of time by subtracting expenses from revenues. This gives you the net income of the business.
So, the income statement lists a company's revenues and then deducts its expenses, which results in the net income of the business. Most businesses use monthly, quarterly, or yearly income statements. The statement of changes in owner's equity describes the changes in the owner's stake in the business, or the capital of the business over a specific period of time.
The first line of the statement is the owner's beginning equity, or the total capital or equity at the time the previous statement was prepared. Then the new investments made by the owner or owners into the business over the time period of the statement are added. The net income is then added because it is an increase in owner's equity. After this, any asset withdrawals the owner made for personal use are also deducted. The result is the owner's ending equity at the end of the period.
With these two statements completed, the balance sheet can now be constructed. This statement looks at the balances of all the asset, liability, and owner's equity accounts at a specific point in time, unlike the last two statements, which extend over a certain period of time, often a year. So once again, the balance sheet examines the balances of accounts at a concrete point in time. So, Mr. Former Prime Minister, is it? What would you say your weaknesses are?
Well, I'm really hard-working, you know, so I tend to just shoot up that corporate ladder like a rocket, you know, right past the people who interviewed me, so pretty soon they're underneath me and I'm their boss. They get a little, they get a little jealous, a little envious, and they tend to be a little crazy about it, you know. They kind of hate me.
On the left side of the balance sheet, all the asset accounts and their balances are listed. These balances are added together to provide the total assets amount at that concrete point in time. On the right side, the liabilities and owner's equity accounts and their amounts are listed. Then, these are added together to show the total liabilities and equity at that concrete point in time.
When a company acquires assets, they will often incur liabilities or expenses. So, for that reason, one side, the left, shows the resources or assets of the company, and the other side, the right, shows the sources of those resources.
To watch more free educational videos, visit our website, studioforlearning.tv. Stretch your brain online.